Next, problem number 15. Mr. Prasad sold a residential house property for rupees 12,10,000 on 15th May 2018. That is in the previous year, 18 and 19. The index cost of acquisition of the property of rupees 2,27,500. So here they have given the index cost of acquisition. So the asset will be the long-term capital asset. Mr. Prasad holds 51% of shares of ABC Limited on December 2018. The total investment made by Prasad in ABC Limited is rupees 8,50,000, out of which the company make the following investment. So here the assessee has sold the house property, which is long-term capital asset, and after selling the asset, he has invested the amount on the shares of ABC Limited by holding the 51% of ownership. So here the assessee can claim the exemption under section 54GB because he is selling the long-term capital asset, either it may be house property or land, and after that he has invested the amount on the shares of the company. So he is eligible to claim the exemption under section 54GB. So the condition says that if the cost of the investment is more than the net sale consideration, then the entire gross capital gain will be claimed as exemption from tax. If not, if the cost of investment is less than the net sale consideration, then the amount will be gross capital gain divided by net sale consideration into cost of new equity shares. So let's check out. The investment is 8,50,000. On 1st March 2019, invested in new plant and machinery rupees 4,20,000. On 10th July 2018, invested on a old plant and machinery rupees 1 lakh. On 31st March 2019, amount deposited in the LG deposit account rupees 2,90,000. So here the assessee has invested rupees 8,50,000 on new machinery, old machinery, and deposited in a account. So all the investment has been made in the previous year, 18 and 19. Correct? Okay. And whatever the investment which has been made on old plant and machinery is not eligible for the exemption under section 54GB. You need to make the investment on the purchase of the new plant and machinery only. So the old plant and machinery exemption or the amount will not be taken for the exemption purpose. So let us solve the problem. Heading as calculation of taxable income from capital gains, asset, house property, period of holding they are not given. So since they have given the index cost of acquisition, so it is assumed that it's a long-term capital asset. First, take the value called as gross sale consideration. So the gross sale consideration which has been given in the problem, that is 12,10,000. The gross sale consideration 12,10,000. Next, from that minus the realization expenses. Since there is no any information, realization expenses has been taken nil, and balance amount net sale consideration, that is 12,10,000. Since it is a long-term capital asset, we need to calculate the index cost of acquisition. But in the problem, they have already calculated and given the index cost of acquisition, that is 2,27,500. We take directly the index cost of acquisition is 2,27,500. Next, minus the index cost of improvement. Index cost of improvement, there is no any additions, so index cost of improvement will be taken as nil. So the balance amount is 9,82,500, which will be the gross capital gain. Now, from the gross capital gain minus the exemption amount, that is under section 54 GB, because he has invested the amount on the equity shares by selling the long-term capital asset of the house property. Right? So section 54 GB that have clearly told the asset should be sold, should be a long-term capital asset, house property or land. After that, they need to invest the amount on the equity shares by holding the 51 percentage. So exemption amount is, since I have told the conditions that if the cost of investment is more than net sale consideration, then the entire amount called as gross capital gain can be claimed as exemption. If not, if the cost of new investment is less than net sale consideration, then we need to apply the formula, that is gross capital gain divided by net sale consideration into cost of investment. So check it out. The cost of investment is, they told 8 lakh 40, sorry, 8 lakh 50,000, but the investment made on old plant and machinery is not eligible for exemption. So the balance amount is 4 lakh 20,000 and 2 lakh 90,000. So the value is 7 lakh 10,000. 7 lakh 10,000. That is 4 lakh 20 plus 2 lakh 90 is 7 lakh 10,000. Now the net sale consideration is 2 lakh 10,000. Since the cost of investment is less than the net sale consideration, we need to apply the formula, that is gross capital gain divided by net sale consideration into cost of investment. To take the value, gross capital gain is 9,82,500 divided by net sale consideration is 12 lakh 10,000 into cost of new investment is 4 lakh 20,000 on new machinery plus amount deposit in a LG account scheme. So after calculating the value, we'll get the amount called as 5,76,508 rupees. So after minusing the amount from the gross capital gain, we'll get the balance, that is 4 lakh 59,000. So 4 lakh 5,992 will be the taxable long-term income because the asset is long-term capital asset.